you suddenly feel like, maybe some tenant sued you for you didn't lock their door, so their stuff is stolen and whatever happened. And that make you feel like, I want to do asset protection, protect myself. And then maybe one of your kids is on drug, and then suddenly you don't want your kid to take over all your money. You want to distribute the money a little differently. And then you think of, I want a different living trust. So all of these thinking as a mature parents, right? We have young parents who are dealing with toddlers, but you also have mature parents who are dealing with big people, right? The big kids. And what do we do in this kind of situation? Or we love them, but we don't want them to know how much money is they're waiting for. So with all of that complex feelings, complex situation, and you, me, and others, and we're growing older. So what do you do? So let's look at today's content. I want to explain to you the difference between living trust and family LLC. Of course, it's a very big subject, but I try to really condense that to the content that you need. We are dealing with small and medium-sized business. I'm not doing estate planning for Elon Musk or for Trump. So I am doing it for you, for people who are day in, day out, work our butt off, make some money, and don't want to lose it, right? So that is our goal. And with that said, let's go ahead, and you see the webinar topic already. So let's just go on with our presentation. So about our firm, Community CPA, I, of course, want to brag about our firm. We are so great. We've come from one client, one person, all the way to today. We have more than 10,000 clients. We speak collectively more than 10 different languages in our firm. That tells you how willing and eager and how equipped we are to deal with people from all walks of life, not just your traditional ways coming through upbringing. We take care of everyone from everywhere. And we have 4 branches currently, and we are actually opening up our number 5 one in Houston, Texas. That one in August 2024. I used to say June, but its construction takes longer. The materials takes longer time to ship, right? So that story is not new, but Okay, now August, but for sure in 2024. And myself, I am the managing partner and the CEO for Community CPA, and I have served on National Taxpayer Advocacy Panel. That is the Federal Advisory Committee to provide advices to IRS. So I served there for 3 years. That gives you a little bit settlement in your stomach, knowing who are you listening to, right? And I also have 2 books that I wrote. Yes, I'm an author. I wrote the 8 a.m. to teach people how to start up a business. Starting up a business is different from growing a business. That's why I wrote the 2nd book, 10 a.m. And you can start up, you can be brilliant, but you may not be able to keep your business if you don't run it properly. Then I'm writing the 3rd book is 2 p.m. That one talks about expanding your business. Yes, you can grow your business to the capacity you cannot grow anymore. Have you ever heard of people saying, I don't take any new client anymore. I'm done. That I'm not saying it negatively. That's maybe your strategy to be that way, but that just says that you are not expanding. You are actually be captivated by your ability to handle more. So when that question comes about, you ultimately need to ask you whether did I read Ying's 3rd book about expanding my business, right? If Starbucks remain as a 1 branch, it can only serve 2,800 cup of coffee in one morning within 1.5 hours time span. If Starbucks is many branches, they can serve many coffee, right? So expanding is that idea. It is to come out of your normal setting and figure things out. So I'm still writing that 2 p.m. I myself, community CPA are going through expansion. So if I am not successful, I can't finish my 2 p.m. book. I have to finish my own expansion to the point I can sit there goes, I'm good. Then I can publish the 2 p.m. Then I have the 6 p.m. retiring from your business. Yes, if you ever retire. So maybe that book is not existed. I don't know. So we'll talk about that later. All right. No responsibility disclaimers. Needless to say, whatever you learn from internet, you might be such a Google person, right? You find all your answers. Have you ever, if you're a doctor, you know what I'm talking about. You see a patient and she already come up with all kind of solution diagnostics for herself. She already checked on internet. She knows why she's sick. And you sit there wondering, why are you coming to the doctor then if you know everything? No, she just wants to use her knowledge and verify what she knows with you so she can be sure that she's treating her illness properly, right? Same thing. And you may listen to the CPA, you may listen to Ying, but you want to do your own search and come up with verifications to make sure that the knowledge is correct. All right, but of course, we do our due diligence. We try really hard to make sure every word we say, every song we sing are being edited, right? And being looked at and being reviewed. And we know that this is the knowledge, as far as we know, it is correct. So, well, we're serving many customers. We have many years experience in this practice. So I trust our ability to know what we are doing. Now, reasons to set up an LLC. I have 2 slides right here to talk about setting up a Family LLC, why that is, what the reason triggering people to do Family LLC. But this first slide, I want to tell you the old type of LLCs out there. There's so many, but I'm only listing these because these are the ones we see the most at a community CPA. If you know that a firm of our size and see these type of LLC frequently, that means what? That's the most common, right? So you've got to understand those. Domestic LLC, most common type, formed in one single state. Foreign LLC is not a foreign country. It's not Mexico LLC. It's not China LLC. No. Foreign LLC are registered in one state, in Iowa, but operating in Minnesota. Those are the LLCs called foreign LLC. Single member LLC, you know what I mean, right? You are the only member, you're running it under single LLC, you probably report taxes under Schedule C, under 1040, and so question answered, right? You know what that is. Multi-member LLC partnership. And 2 people, 3 people, 5 people, multi-member LLC. Very often, and when we do 1065, it is all multi-member LLC. Professional LLC or PLLC are especially maybe a multi-member LLC as well, but with a professional license, like CPA firm, right? CPA firm can be a professional LLC. Family LLC. What is Family LLC? A business entity formed and operated by 2 or more family members to manage financial, to take legal responsibility. A key here, members must be related by blood. They must be related. Family LLC. Series LLC are layers of LLC for advanced liability protection. When I say layers, you can have 1 LLC on the top, and then 2 LLC on the second layer, then 3, 4, 5, 10 on the third layer, and each one roll up to itself to the other LLC, so your protection is unlimited. For example, you bought a house, and you formed it on this LLC. But this LLC's member is the upper layer of LLC. The upper layer of LLC's member is the upper layer of LLC. Don't you have a lot of layers? Yes, that's called a series of LLC. So those are most common. Now, let's go to look at Family LLC. So we got here, right? So what is Family LLC? Family LLCs are set up by blood-related relatives. Family, right? That's why it's called Family LLC. And they use this LLC to do what? To do asset protection, So separating your personal wealth from your business, because you're carving that business into a family LLC. It's a business entity, folks. It is just like a corporation. It is carved in as a for business. So if you got a liability over here, it would not affect your diamond ring on your finger, because you won't pay that to pay up the liability because you have a LLC. And estate planning is also used by family LLC because and you can actually start moving your membership, your shares. If you know ownership, shares, membership, you can move those into your other family member. For example, your son. For example, your daughter. For example, and your spouse. So anyone inside of here, you can start moving them. You have control. Yes, you do. If you operate a family LLC and you're the one collecting all the rent and paying all the bills, and you make yourself with the control, you of course have control. You can make sure that you don't pay your kids because, even though they have some shares, but these kids are rotten. They don't do anything. And you want to make sure that you have in your operating agreement where you pay the kids the least of profit. So they don't get the money and they can't do anything with it, right? Tax benefits. Of course you can plan because you are a family LLC. So basically you are a entity. There's so much tax planning, tax benefit you can take. If I just randomly thinking in my head, we can set up a life insurance in the family LLC and claiming on your life. So if you die, life insurance pays to the family LLC. So there's tax things that you can outplay a entity. Just need to plan. You cannot thinking that, I set up a family LLC, so I got all of these benefits. No, you have to plan that, right? You have to structure it inside of the LLC. Of course, the family LLC will keep the asset in the family, and it's flexible because you can change it. You can change the ownership. You can change your profit and loss distribution. And estate tax reduction, of course, if as a parent, you got too much money, and you know that after you die, you're going to pay estate tax. That's a lot of tax to pay, folks. So to avoid that, and you would have this family LLC in place already every year, you're gifting your membership unit to your children. By the time you die, maybe you only have 1, 2, 3 unit left. Then of course it's gonna reduce your estate tax, right? And the business succession planning coming into family LLC. If you have a family LLC, you don't do that. It feels like, why are you doing the family LLC, right? And the creditor protection, needless to say, if you put all your business in the family LLC, that creditor can only reach over here. Privacy. And family LLC, the privacy is sort of limited. It's not as private as trust, but it is still have privacy. And you're not publishing your tax return everywhere, right? You only had a registration with the state. Maybe people can tell who is the key member of the family LLC. But the rest of the split is really just in your tax return. As long as you don't send your tax return to broadcast what you have and who has what, then people should not have reasons to know how you work within your family LLC. Now, these 2 slides I just talked to you are about family LLC. So it is one type of LLC. It's not much of a difference from many other LLC. Of course, because it is family LLC, so the members must be blood related, that you know that. And then, of course, people set up family LLC for all of these good reasons. So now let's take a look at a trust. We're going to start with 2 slides on trust as well. For the type of trust are often seen at community CPA. I say that because I want you to know what is most common. And, yes, like I told you, community CPA is really for the community members. We don't have some elite people that you can find on internet like Elon Musk to be our client. well, I do have famous people on my list to be my client, but not at the Elon Musk level. All right. So with community CPAs, 10,000, 12,000 clients, we have seen these kind of trust. So that gives you an idea that this is a normal, regular, often seen, and an ordinary people trust, right? So the first trust is revocable living trust. Whenever you hear people talking about living trust, normally it's revocable. Revocable just means that this trust is really can be changed by you, by grantor. You're the one setting it up, so you're the grantor. And you can change, cancel, do whatever you want. You don't like your kid anymore, kick them out, okay? And you like someone else anymore and so much, suddenly put them on. Trust, living trust, goes with your brain as long as the brain is still working, right? That's revocable. But there is a kind of trust called irrevocable. It's as important as this revocable one, because a lot of times when people talk about asset protection and they immediately think of trust, actually when you talk about asset protection, I immediately think about Family LLC. On the secondary note, I think of trust because you have to set up specific trust to be asset protecting. That is irrevocable trust. Once you establish an irrevocable trust, you cannot change or modify it, okay? It is used to create a safe haven for the placement of the asset inside of the trust. So it is like sealed in a container. It's not yours anymore. It belongs to the trust. When you die, then that asset goes to your beneficiary, okay? And this trust protects asset from claim of creditor, beneficiary, even Medicaid. And you know what I mean by Medicaid, right? So when a person dies, if this person owes a lot of Medicaid money, Medicaid will send the dead person a letter saying that you owe me this much money. Do you have an estate? And if you have an irrevocable trust, it's not in your estate. But if you have a living trust, it's still in your estate, right? So that is what the difference between the trust. Then of course the other kind of trust is called a will trust. It is really effective when you die. So some people set up a trust saying that after I die, all of my money goes to the cat I love. You know, they call that pet trust as well, but this is a will trust. Basically, you're saying that after you die, and all your $1 million is going to go to take care of this cat. So that is your will. Only happens when you die. So you can form that kind of testamentary trust, right? It's called a will trust. Charitable trust. Charitable trust has two kinds. One is CRT, one is CLT. CRT and just means that you would receive the income, but the leftover goes to the charity. But the other one, the lead one, is actually you name which asset should go to which nonprofit. So it is in generally speaking, it is the way to donate, and you can donate, but still have some money to yourself, right? Special need trust provides for special need dependents, such as a child, sibling, or even parent. It does this without compromising their government help. You know how sometimes when you have a handicapped child, and the child receives some benefit from the government, and if you have too much income giving to the child, then they will lose the government support. Let's say the child is totally disabled, so it really cannot make money, but you have this special need trust coming in with the money goes into helping this child, then this child will not lose the government help. So that's why people have this special need trust. We have seen those. Generation skipping trust are the parents, and they rather transfer asset to the grandchildren than to their children. So maybe their children are also not well behaved, But they like their grandchildren. So they will set up this generations giving trust for the grandchildren. And you can, set this one up particularly. This trust will let you pass asset to your grandchildren, allowing your children to avoid paying estate tax, because you give your money to your grandchildren. So when you die, your children would need to help you to pay estate taxes. They don't have to, because it's already went to the grandchildren. So this is where the trust would come in. So having said so many trusts, I still want to pull your attention back to living trust, right? So the living trust is the one that most common. People are setting it up. Our life changes. We don't know. And right now the kids are all good. God knows 15 years later when they become a young adult, what they're going to do, right? They may do something you just do not like. And in that case, you can exercise your power to change that revocable living trust, not to lock yourself down and then, can't change anymore. So with that said, and there are people setting up trust for these reasons. So they set up a trust for probate avoidance. This is one thing I haven't mentioned yet. When you set up the trust and you're grantor, right? So all of your, after you die, all of these work, and it will go to the trustee. The trustee could be your child, could be your neighbor, could be your mom and dad, who knows? So that trustee is doing the work. So the trustee do not charge you probate charge. But if you die without a trust, everything goes to the state you live. That state has a probate lawyers will handle your handover. Okay, this one goes to your son, that one goes to your daughter. And if you leave with no will, and they're just gonna be divided even, they're gonna post on the newspaper asking, hey, this person died. Anybody knows that, is this person owe anybody money? Then people will, maybe some people will come up and goes, oh yeah, before he died, he owed me $500. So the lawyer will treat those kind of things. So they charge a fee. That fee is from 3% to 8%. Every state could be different. Every legislature can move up and down that fee. So to avoid probate is so meaningful. And the one thing I want you to understand, the probate is charged on the percentage of your asset, your total asset. Let's say if you have $1 million asset and you borrowed $900,000, you only have $100,000. Your real equity. So after you die, the property need to be sold. So let's say it's sold $1 million. So 900 went to the bank, 100,000 in you're the child, so you have that in your pocket. The probate charge, if it is handled by probate lawyers, if it is 3%, the probate charge want a $30,000 from you, because that's a 3% of $1 million, not 3% of the 100,000. Make sense? So it's a 3% calculated on $1 million, not on the 100,000 equity that you have. That's why probate charge can be very pricey, and you want to avoid that. And the privacy protection, very important. If you are somewhat known in your area, and you may not be wealthy like Bill Gates, but in your little town, people know you, and they think you have a lot of money, and you don't want people to know that. The best way to make that privacy yours, nobody knows what you have. Maybe you have too little, but you showed up too big. You still don't want people to know. In that case, and you want to do a trust, you want to close your estate under a trust instead of going into probate, because it will be public information. This is why you remember Michael Jackson, right? He died suddenly. And his mom filed the estate file with the California state, and assuming he did not have a living trust. So what happened is everything is in the open. I'm sure you remember those noises in the very beginning, how much he has, what he worth, and it's like it's wide in the wide open. But later on, they discovered the living trust. they discover the trust, so everything shrinks back. So this is where privacy can be so sensitive. And when you are a little well-known person in your area and you die, yeah, you want your privacy, then you set up a trust. Asset management during incapacity. This is very often useful. So when you set up a trust, you are the grantor, you have a trustee. So for example, if you have a properties or you have a business that you're running, and you already know one of your 7 sons are running it, the other 6, you don't know what they're doing, and this is just one son is really helping you. So you make that son a trustee. Then while you are sick or whatever happened, you die, then that son can continue running that business, right? So managing your business. And you in that trust document, you can actually you can direct give your direction on how you want the son to manage that. So that way, he as a trustee has the right to manage your trust with the other 6 siblings, right? Flexibility and control, you can change your trust. Yes, you can change your trust. Wake up in the morning, you don't like one kid, go change it. Wake up next day morning, you like that kid again, change it back. So that is the flexibility. Asset protection for beneficiaries, this one really comes with that irrevocable trust. Revocable, not so much. Irrevocable, yes. Tax planning, of course. You want to know how much estate threshold is. Right now it's 12.6 million, right? But Obama's time was 3.5. So, of course I didn't live 100 years. I don't really know what's going to happen to the future president. But my summary of the experience of the past is that if the president is older, the estate threshold will be higher, because obviously the president also wants to not pay taxes. But if the president is young, and then they don't care so much about estate tax. They want to tax the rich so they can get some money for the government. Nothing wrong with Treasury needs some money, right? So we had 3.5 million from Obama's time. Now it's 12 point some million. Very big difference. So that threshold need to be planned. You do have to think about what if a young president in their 20s come up, right? And trust me, and that estate threshold will be down to 0. So everyone, whoever dies, gonna pay something. So really, I hope it sounds like a joke. So at least you can kind of sink into your thinking, right? But these are the things crazy tax people are thinking. So that's tax planning side of trust. And continuous asset management, of course, is a reason to set up a trust, right? So they have trustee, they know that who is going to take charge of what. So the grantor, the mom and dad, and can sit back, relax, knowing that everything is in order. So this is trust. And a lot of time the trust comes with last will. It's the will that they update all the time. So trust is really a good tool. The living trust is a good tool to manage your, afterlife and with your today's thinking. If you want your today's thinking be reflected after you die, you go through living trust. All right. Now, these 4 slides we have gone through, we just talked about Family LLC, we talked about trust. I hope I loaded you with a lot of understanding, knowing that Family LLC is special, but it's nothing too special. It's just an LLC. And the trust, living trust, is special, but nothing too special. It's just one of the trusts, right? So now, what's the difference between a trust and a LLC? Number 1, tax structure. Of course, tax structure is different. If you do a living trust, because it's a living trust, so you don't need to file any taxes. But you do a LLC, immediately you need to file annual taxes. So that's a tax structure is different. Tax structure just means that the trust is a fiduciary arrangement for holding, managing asset. The LLC is what? It's a business entity. So, the purpose is not the same. The purpose for trust is primarily used for estate planning, asset protection, and a smooth transfer of asset to beneficiaries. When I say asset protection, it of course does protect in a certain trust, right? So I also mentioned to you that living trust asset protection is not as great as a family LLC. Family LLC are typically used for managing family business or investment, providing liability protection and tax planning. And asset ownership in trust, assets are legally owned by the trustee for the benefit of beneficiaries. So if your parent has a living trust and you name your oldest son to be the trustee, then it's actually the assets are legally owned by the son, but for the benefit of the rest of the siblings, right? And in the LLC, assets are owned by company itself. So members have ownership interest. The LLC owns the asset. So that's why when the asset have a liability or anything like that, it is the LLC's liability, is not yours, not the members. Some members totally don't have anything to do with the liability. On the control side, trust assets are managed by a trustee. That you got it, right? And LLC assets are managed by members or managers of the specific area, and those should be laid out in the operating agreement. Liability protection-wise, LLC generally provides better protection from personal liability from business debt and legal issues. Trust offer limited liability protection. Depends on the type of trust, you see. Privacy, of course, trust offer more privacy as they are not public recorded by the LLC. You register that on the SOS, Secretary of State, so it is somewhat public filing, right? But of course, I also said earlier that if you have LLC, your equity, your income, your expenses are all different that laid out in the operating agreement. Your operating agreement is not public information. So that gives you that privacy. Taxation-wise, LLC offers more flexibility in taxation. So flexible. I would not have time to really explain that to you. But LLC is such a flexible, like the females, like the clays, like you can shape them. You can do things with the LLC. And allowing for past due taxation and corporation taxation, trust have specific tax rules. Trust is more rigid, but your LLC can be so different. You can be taxed on the corporation rate if you make that a corporation, right? So with that said, let's look at two more items where we say the difference between trust and LLC. And the trust, on the ongoing maintenance side, LLC requires more ongoing maintenance because you have to file taxes every year, and your membership may change, your operating agreement may change, and you may buy a new asset and retire old ones. All of these things LLC need to do. But trust doesn't have these kind of ongoing maintenance, especially the revocable living trust. You don't file any taxes. But of course, at our firm, we understand the importance to keep your living trust current. What we do is when we do the year-end tax planning for our client, if you have a living trust with us, we actually automatically update your living trust based on what you bought new property or based on what you sold. Whatever need to be updated in your living trust will be updated. So we have that system put together. But again, if you did your living trust with your attorney and you don't see the attorney most of the time, only when you're in trouble, and in your lifetime you may be never in trouble, then you even forgot who was the attorney you did your living trust with, that's not good. You want to work your estate side of business with someone that you really know gonna be there for you. If you die, they already died 20 years, that's not good either. So I never encourage people to do estate side kind of planning with a single person business. No, it doesn't matter how great they are for a lawyer or CPA, you need to work with a team. You need to work with a company, with members inside, right? Asset transfer. Trust can provide for smoother, more private transfer. Of course, because if you have a trust, all these transfer are private, and it is not going to be publicly announced like what a probate lawyer would do, right? But LLC requires additional step for transfer because when you do transfer, your tax return need to reflect that. Maybe even your Secretary of State filing need to update. So that is why they're saying that the asset transfer is easier on the trust, is harder on the LLC, because you ultimately need to consider the tax consequences when you do that with the LLC. Now, we just spent several minutes talk about the difference between trust and LLC. I hope you got a little bit understanding, felt like, oh yeah, they're a little more separated than what I was thinking before. So now, the next 3 slides I have is to talk about which one should you use. So now you say, oh yes, great Ying, you got me confused enough that now I don't know which one to use. Can you just summarize in most of the cases what people do, like when to use a trust or when to use an LLC, family LLC? And is there any better ways to even combining them? So let's look at what I got for you. So for estate planning, to use a trust, when privacy is your top priority. You're just like so concerned to have people know what you have. Then trust, for sure. Or you're so concerned with your probate money that you're gonna pay too much money, then yes, you're gonna do a trust. And you need to manage and protect all kind of asset, including cash, security, personal property with your belonging. So you're like, oh, I've got too many things. You know, I have gold bars sitting in my basement. I have this $1 million diamond ring on my hand. Nobody can tell it is $1 million. So all of these things, and you feel like that you need to manage and someone need to know. So when you die, it's not gonna be sold in the flea market and people didn't even know your ring is actually $1 million ring, right? And if you have those kind of concerns of your personal owning, or you had a picture that you knew the value, but nobody else does. And if that is the case, and you want to make sure you have a trust, put that in the trust. And putting in the trust what that picture is, how much the value could be, who do you want to give to, and everything in there. And reducing estate taxes, absolutely. So this is more of using a trust, putting away your asset. For example, if you have an asset, you know you're going to leave that for your children. You don't even want that to be under your estate. Then you can set up an irrevocable trust, right, to put that property away. So that would reduce your estate tax, lower ongoing maintenance cost, and you care about paying your CPA too much money every year, don't want to do this, and just want to get the trust done so I don't file taxes. There you go. You use tax, right? So you use a trust to manage that. So this is when people would use trust. But in what case people would want an LLC instead of a trust? Then you need to manage, protect the business asset or real estate investment. So if you have an ongoing business, you are taking rent in, you're expensing it out, you have a real business that is going on, and it's just too active to leave them on the trust like your diamond ring, then you need a family LLC. And a personal liability protection, right? From your property. Maybe your property is just getting so big And God knows who's going to sue you for what. And you want to make sure that your diamond ring and your good picture is not going to be affected by that. So your liability is cut off from the business, protecting yourself. That you need LLC. And retain more control and enjoying tax benefit. Oh yeah, we can't do tax planning for your living trust, but we can do tax planning for your LLC. And it just depends what kind of LLC you have. And for example, and maybe the LLC, certain people is a passive. So when you move money into those passive members, they don't have to pay self-employment tax, right? That's a tax planning. That's a lot of things related to tax can come into play when you have a real business entity. And you have people, if you have a large, diverse portfolio of assets to manage, this is more related to the first point. If you have such an active business, and it's just so active that you know, every day you have to watch it, every day you have to look for it, and that is your family LLC, is not your living trust, folks. And you don't really, living trust really is place that should be sort of stationary, right? Sort of stable. And you know, if you're looking for flexibility in tax and your new management structure and the things that keep on changing, LLC. See, I'm kind of giving you a general sense of, okay, for my estate planning, and if I have to do something, what should I do? And you can do the family LLC because of this. The structure side of things is very important because you can slowly, in 10 years' time, to move all of your assets from you to your son and without incur any additional taxes. Because there's a gift tax we can work with, there is business membership unit valuation that we knew how much per unit cost would be. Then with every year's gift filing, and we maximize the gift amount to the allowed amount, then you move the shares over to the children. So these are important estate planning tools. Now, for estate planning, which one should you use? And in many cases, a combination of both. A trust and LLC can provide the most comprehensive estate planning solution. This is where, you know, coming to this time of the webinar, you sort of got a sense that, you know, it is so drastically customizable for what type of estate planning package you should have. There's no one the same. So occasionally we hear people that, oh yeah, I know my neighbor and he did something with you. We just do exactly the same. We are exactly the same family. We even work in the same place. So it's really, you know, you can literally just copy what you did there to our family. No, because estate planning is not about what money you have. It is really about what beneficiary you have. They may have very reliable children and you don't. Or you may have very conservative children, but they don't even want to have anything from you, right? So every family is different. Mom and dad, the love of the heart is the same. You know, every parent wants to do the best for their children, but the issue on hand is your children don't see the best you do for them is the best. Don't confuse yourself or project your own thinking to the children because they don't want it. They don't care about what you have. But of course, you say that, no, Ying, they do. They just not grown up enough that to realize they do. Yeah, but that's the reality. If you move these assets early and they got a K1, they will swear at you. And mom and dad, what are you doing? I want to file my taxes on April 15, and your K1 is not here, and I don't want that. You make my life a mess, and I don't want you to do it. Have you ever heard of that from your kids? I have heard of that from my clients' kids. So I knew what you think is right may not be what they think is right. So the best estate planning for a parent is to plan in such a way that it doesn't affect your kid. They don't have to know, and they don't have to use, and they don't have to project, and you yourself doing it. Is it possible? Yes, it is possible. But that is so customized to you and so customized to each family. It is not something a webinar can do. But I will look for volunteers right now. If you want to get that estate planning ideas from our firm for free, and you agree coming to webinars, we will sit here together and I'll plan it out loud for you with your family situation to give an idea of how customizable, how complex inside of that planning. It is not a LLC can resolve, it is not a trust can do. But some cases, yes, but not all the time. So now I just want to give you one example to say that combining both is the best. The reason I say that is you can place a LLC inside a trust. Maybe it is so abstract for you when I say that, but I just want you to remember it. You can place an LLC inside a trust. So that's an extra layer of asset protection, that combining the benefit of both structures, and also with the complex asset portfolios that you have, combination will offer more flexibility and absolutely tax saving. So with that said, we kind of come through what I prepared for you. In the very beginning, we talked about the Family LLC and all kind of LLC. So what is Family LLC? Why people do Family LLC? Then we talked about trust, all kind of trust. But what is living trust? Why people do living trust? Then after we did these two definitions, we looked at the difference between the two. So we conclude that it's very different. But if I use one sentence to say what exactly that difference is, I would say that trust is more stationary and your LLC is more operational. But they both offer different benefit, right? And then now you are saying, okay, what do I do? So why would my neighbor only do living trust? Why would my left side of neighbor only do Family LLC? Now you know what's their emphasis. For the one who did a living trust, they want protection. They want privacy. They want privacy, they want to save probate cost. If they did irrevocable trust, they want a protection. But the person who did a Family LLC, because they have vast asset inside of there, and they have children, they want to move their gift, their ownership to the children to reduce their estate tax when they die, and they think they still have years and years ahead of them to move that money. Different people has a different plan, right? So this is why these two are not the same, but you can combine them. You combine them for a purpose. Just like I said, you have a big Family LLC, but the members don't have to be a person, can be your trust. That is where you place a LLC inside of trust. You can change your LLC membership all to your trust if you want, right? So these are the layers, things that we can work with, and when we come to specifically your case. All right, allow me to wrap up today's webinar. And if you really desire to talk to me, and you go onto the website and go to appointment button. We're big with appointment, right? Because my books is like appointment with Ying at 8 a.m. You know, one time I met a client at 8 a.m. and they come in, they go, we're coming in appointment with Ying at 8 a.m. That is the book title. So it's not a coincidence because that's really about my professional life. Just a lot of appointments and I meet a lot of people. And you can click me when you go onto the website, you will see the appointment button. When you come in, you will see all the partners here. These people are not ordinary people. They are extremely intelligent creatures, I'm telling you. They know what they're doing, and you can select any one of us and tap into our talent, and we'll give you the answer. And here, one more thing to tell you. And you also can email Catherine at communitycpa.com. She is a jack of all trade is the best way to describe her, because she is a librarian. She does a lot of my PowerPoint, putting it together and have me go through it. You think I have time to do all of these? No, Catherine is behind the scene, and she is the one getting all the input from you to tell her what would be the best to talk about next time, or next year, next month, next week, because we do so many webinars every week, right? So I do it on Tuesday and on Saturday, and then we translate the content into Chinese and Spanish. So we're very active in our YouTube channel. And you can email Catherine to get her to organize a topic for what you want to hear. And we are the only CPA firm, so far I know, open 6 days a week. I do not see any other CPA firm open 6 days a week. And we're not slave drivers. We have 2 shifts. People work Monday to Friday, Tuesday to Saturday, right? But we have the people who are willing to provide the flexibility to our client who may not have time Monday to Friday. Their only time is on Saturday. We are open for you, 8:30 a.m. to 5:30 p.m. And I'm grateful that you're here today. I hope you learned things, 1 or 2, and please subscribe to our channel and give me a thumb up. If you really think I did a good job, the only way I know you think I did a good job is to count on how many thumbs I got on each of the webinars. So please don't be stingy and give me your thumbs up, and I'll see you again on Tuesday. Bye-bye.